Oppenheimer's Tyler Batory here to talk about the home builders, which really have kind of hung in there, Tyler, pretty well. KB Homes, pretty good numbers there. Stock is responding. We believe that we've seen the low in home building activity?
So we think that we can, and we're constructive on the home builder industry. We're very constructive on these stocks as well. A couple of points that'll make you look at mortgage rates. Stable in this 100 basis point range between 6% and 7% since the fall. Demand appears to have bottomed in November and improved sequentially here into March. That's something that we heard from KB Homes last night. And we think the public builders are really well positioned in this environment. If you look at the existing home market, there's really not much inventory. That's an opportunity for the home builders to take market share. And if you look at where these companies are positioned right now, leverage has never been lower. Balance sheets have never been in a better position. There's a focus on returns, buying back stock. So we think there's a number of tailwinds here for the sector that can drive these stocks even higher.
Doesn't the affordability equation have to start working more in favor of buyers to some degree here? Because that is the piece. You mentioned rates are stable, but just in general, prices have not given way very much.
Yeah, so it's a great question. I think one of the key advantages of the home builder business model is their ability to offer incentives. So if you look at the prevailing mortgage rate right now at about 6.5%, if you're in the existing home market and you're looking to buy a home, it's probably what you're going to be paying. If you go to a home builder, they can buy down that rate, get into the 5% range, perhaps even into the 4% range. They're also lowering prices as well to try to drive sales. So yes, affordability is a concern. This is something that we're very focused on, but I actually think it's a competitive advantage for the builders in this housing market. And it's really a reason why we think they can take market share from the existing side of things.
Is there a way to handicap how the banking stress might make its way into things like single-family mortgages? I know mortgage spreads on the securities have widened out, and obviously banks are going to be a little more in kind of risk mitigation mode right now.
Yeah, so far, and it's still early, we haven't heard any changes to mortgage underwriting standards. I mean, if you look at where things have been really since the great financial crisis, pretty strict in terms of how the companies are looking at mortgage underwriting. What I would really watch, a lot of the private, smaller builders out there, they actually do use a lot of local regional banks to fund their operations, to fund their land acquisition strategies. So perhaps there could be a little bit of dislocation on that side of things. I think it'd be a positive for the public builders, just given their capital positions, potentially presents an opportunity for them to take some market share.
And which one or two of the builders do you prefer at this point?
So PHM, Pulte Homes, that's our favorite name in this space. And if you look at this company, balanced buyer exposure, which we like, offers a little bit of a hedge diversity depending on which sort of buyer segments are doing better. They have a backlog of homes that they've already sold. That lowers volatility, gives them a little bit extra visibility in terms of their earnings. And if you look at their capital position, they're very focused on buying back stock, should have some of the best ROE metrics in the entire sector this year. Valuation trades below its long-term average as well. So Pulte Homes, PHM is the best way, we think, to play the strength of the home builders.
Tyler, we appreciate it. Thanks very much.